Welcome to Make It Last, helping you keep your legal ducks in a row and your nest egg secure, with your host, Victor Medina, an estate planning and elder law attorney and certified financial planner.
Hey everybody, welcome back to Make It Last. Thank you for joining us this Saturday morning. I am so happy to be with you. As the announcer said, my name is Victor Medina. I am the host of Make It Last, where we help you keep your legal ducks in a row and your financial nest egg secure. And I'm excited for today's show. It's one of my favorite topics to talk about. We're going to spend the segments 2 and 3 talking about investment fees. And every time I give this presentation to a group, their eyes open wide because for the first time, they're being explained and taught, how much they're paying in investments. So I'm very excited for that, and I can't wait to share that information with you. But before we get started on that, I wanted to talk a little bit about a kind of a cautionary tale. Because as you know, I kind of have two professional hats that I wear. When I'm not hosting this radio show, when you're not joining us these lovely Saturday mornings listening to the show, I am an estate planning attorney with an elder law focus, as well as a certified financial planner. And, I wish that the majority of our clients, came in with lots of time to plan and, good health circumstances, basically not in crisis. But that's not the case. It's just human nature to kind of wait until it's almost too late to seek the help that you need. And, one of the things that we see a lot is that the people that come to us for help with an elder law situation, they do that really late into a process. So what they'll do is they'll wait until somebody's sick, or they'll wait until somebody is in a nursing home, and then they'll start to do the crazy research that it takes to find an elder law attorney and somebody that can help them. And they're not often thinking with their kind of most relaxed brain on. They're in crisis mode, and kind of like any port in a storm, they're kind of looking to something that's going to be able to help them. And many times, we'll meet them because we'll have done work for a family, and they'll come across that family and say, well, who did you use? And they'll recommend our services. So we'll see a lot of people refer to us for planning, in crisis, where we're meeting them after an event has occurred. And that's kind of late. And so the cautionary tale I wanted to share with you is about a client family that came in to see us pretty late into a process. I often will meet with the healthy spouse of an older couple where one of them is starting to face some dementia problems. And so that was this family. It happens most of the time, just happens, I guess, in my practice. Most of the time, it's the husband that's sick and the wife that's taking care of him. And they kind of get to a point where they can't take it any longer. And they'll come in and see us. And so I met this family, and mom, I always call him mom. That's the wife, I guess. But mom is dealing with dad, and dad has started to take on behaviors that threaten mom. Gotten a little bit more violent, wandering, not really paying attention to whether the gas stove is off, and it's kind of dangerous, And they're coming because they now realize that they need the next level of whatever care that is. And they start to see the bills that are associated with that. And they realize it's kind of really expensive. And they'd like to save some money if they can. They realize they might spend it all. So they come in and see us. And in this case, as I said, dad had gotten a little violent. So it was a very sad situation because I'm certain that this had never gone on in their life before. Mom had never called the cops on dad, on her husband, because he just wasn't a violent type. But because of the dementia, and we can read all kinds of things into this, but maybe his frustration his frustration at dealing with not knowing what's going on. He had gotten a little bit more physical, and we needed the police to separate them. In fact, they had called the cops a little bit before, and they were working on a very short time frame to find a facility to put Dad into, and then think about the rest of the planning. Like, how are they going to save any money or do anything to help protect assets and keep up a good quality of life for Mom? And the cautionary tale is really about the idea that too often we remain blind to what could be coming around the corner. We think that it's not going to happen to us, that no matter what story we're being told, that people get sick, and when they get sick, the care gets expensive. No matter what that story is, we rationalize the idea that it's not going to happen to us. And so we stick our heads in the sand, and we don't take what could be preventative action. Because what I didn't tell you about this family is that it wasn't the first time that we had seen them. The first time that we saw them was 2 years earlier, when Dad was a little bit more with it, and we were explaining what the options were, explaining to them the need to have a plan in place to deal with the contingencies that might come up later. And they decided not to move forward at that time with our planning services, that they would kind of think about it or wait on it. Quite honestly, it was a couple of years ago, and we see so many clients, I don't really remember what their answer was to us about why they didn't move forward, but they didn't. And it saddened me as somebody who cares about what happens to our clients, because I know that if we had had the opportunity to talk to them and move forward with a plan, then as Dad's care needs increased, as he got worse, we would have been able to deal with it, because we would have had the plan in place about what to do next. And so this cautionary tale is a plea. It's a plea to everyone who's listening. If you know of a family, or if you're currently facing something that's related to this kind of elder care planning, these long-term care costs, please, please, please go and visit with somebody who specializes in elder law. Visit with them and follow through on their recommendations, because as an elder law attorney, I've seen over 1,000 cases, and I kind of know what's coming around the corner. So if I'm making recommendations about what to do to help plan for this, I'm doing it because I'm really concerned about your best interests, and I want to make sure that you don't have problems in the future. And this is one of the ways to do that. So if you're in that situation, reach out to an elder law attorney. If you know of somebody who's in that situation because you know what's going on with the family, take the steps to talk to them and really help them understand where the value would be in putting a plan together, because we don't know what's coming tomorrow. What the status of tomorrow isn't promised. So being able to put a roadmap in place that thinks about different kinds of situations and helps put a plan together will only benefit you. And it's always harder to do that kind of planning when you're in a crisis, trying to figure that out. All right, enough. We're going to take a break right now, and when we come back, we're going to talk about investment fees. I've already told you it's one of my favorite topics to talk about, so I'm going to get really excited about it. Just stay tuned. We'll be back right after this break.
Hey, it's Bert. I hear a lot from people that the one asset they're most interested in protecting from the devastating cost of assisted living or nursing homes is their own home. The team at Medina Law Group can meet with you to discuss options to help protect that home, including their special Home Sweet Home Trust. It's designed specifically to protect the value of your home in the event that you need long-term care in the future. Just call the experienced elder law attorneys at Medina Law Group at 609-818-0068 to learn more, including your chance to schedule a free consultation. You can also visit MedinaLawGroup.com to learn more about protecting your assets assets and the Medina Law Group team. For peace of mind and a solid foundation, call Medina Law Group at 609-818-0068 or visit MedinaLawGroup.com.
All right, welcome back to Make It Last. Today we're going to be talking about investment fees, and specifically the fees that your broker or your investment advisor or in your investments, the hidden fees that we might not know about. And so I'm going to kind of cover 3 areas of fees. And I need you to understand that this is not all of them. We're going to cover as much of them as we can. We only got 2 segments, only about 17 minutes to go through it. But when we think about that, I want you to realize that these aren't all your fees. But it is important to go through them, at least these 3, because even this can be eye-opening for you. You know, when I meet with clients, one of the first steps that we take in evaluating their investments is to look at the expense ratios of the portfolios that they've put together. Because very often what we have found is that the investments that they're in are expensive for what they're doing. They're expensive overall, but they're certainly expensive for a passive investment strategy. And so it's important to kind of go through that. So we're going to cover 3 areas. The first area, we're going to talk about advisor fees. What do advisors charge? How do they get compensated? Expense ratios, which are part of mutual fund fees, and the fees that are associated with the variable annuity. Now, if you have read my book, Make It Last, ensuring your nest egg is around as long as you are. That's the one with the blue cover. It talks about finances in retirement. Then you know that I hate variable annuities. I have called them in the book the scourge of the earth. And I'm going to talk to you a little bit about why in this very important show. So we're going to talk about that. Advisor fees, expense ratios, variable annuity fees. Let's go with advisor fees. Now, advisors are compensated primarily one of 2 ways. Either they are a commissions-based advisor, or they are a fee-based or fee-only advisor. Now, in a commission-based advisor, the advisor is paid in the form of commissions for investments that you are in. So you, as the client, put your money with this big brokerage house. The brokerage house pays the advisor, and that means that advisor can recommend, and often does, investments that pay them out more, but which may not be in your best interest, because they're getting paid as a percentage of the commissions, as a percentage of the investments that you're in. So imagine, like in these big investment houses, the ones that all start with the letter M and got the big bulls on the outside, right? They have a menu of investments that they're recommending to their advisors to recommend to their clients. And in these investments, there are payout grids, which tell them how they make more money on certain investments. Every month, those investments might change, and the payout for them might change. So basically, the advisor is being incentivized to sell particular things because they make money as a percentage of the commissions, as a commission on what they are selling, okay? And that's also the case, for instance, if they're primarily an insurance agent. I've already talked about this. The whole world about financial advisors is that anybody can call themselves a financial advisor. They could have just an insurance license and, they're still a financial advisor, but miraculously, every solution has to do with insurance. You got to buy this annuity product, got to buy this life insurance. They can't cover everything because they're not licensed to cover everything, but they get paid on commissions, and so they're going to sell the thing that pays them, because they got to pay the mortgage when they get home. Anyway, commissions-based advisors, whether they're in a brokerage house or they're insurance people, those are the folks that get paid based on what they recommend. And their pay can go up or down based on the commissions that are paid out on that. Now, if you contrast that with a fee-only advisor, right? A fee-only advisor is someone who gets paid regardless of the financial products that you are in. So they work directly for you. You pay them. They charge a fee. They could charge a flat rate. They could charge a retainer on a monthly basis, or they could charge a percentage of the assets under management. Now, the way that we do things, we charge a percentage of the assets under management, and we think that that's fair because our fates are tied to those of our clients. So if the account value goes up, we get paid more. If the account value goes down, we get paid less, right? But we are in line with our client's best interest by charging a percentage of the assets that we're managing. But it doesn't matter what we recommend. So it's on our best interest to recommend the thing that is best for our clients. In fact, it's in our best interest to recommend the least expensive thing for our clients. Because if the funds themselves don't take money out to pay themselves, then there'll be more money in the account and we'll be incentivized because we'll be getting more money out of that. So a fee-only advisor doesn't have any incentive to sell any particular financial products. They work for you and not the investment company. And so that gives them the opportunity to recommend, just about everything. There's another reason why someone who works on a fee basis is preferable to somebody who works on a commission basis. Because someone who makes on a commission basis, they are incentivized. They earn a commission on every transaction. Whether you buy or sell something, they'll make a commission. Whether or not the investment goes up or down or sideways, they'll make a commission. Sometimes, I know this is illegal, but it's very hard to find. They'll make a commission when they make you move sideways. It's called churning, where they just sell something to make a commission. So if you're finding yourself in a situation where you get called routinely about making an investment change, you got to think about whether or not this person's getting paid as a function of the commissions that they're charging or receiving for making those investments. Now, I have one other topic to cover on this, and it is partly related to the expense ratios before we get to the break. But there are also commissions embedded in the investments that you have. So if you have a mutual fund, that mutual fund may have multiple classes of shares. And you'll be able to see it on your statement. So you might see a share class of I. You might say I afterwards. That's institutional. You might see A or C. And so when you look at those A or C share classes, what you're seeing in there are hints about what kind of commissions might be embedded. Typically, institutional shares don't have any commissions, which they call sales charge, but it's a commission for the sale of that particular share. But an A share might come with a 4 or 5% commission up front and an ongoing trail commission that's payable to the advisor. It comes out of the investment, but you never see it because it goes directly from the investment company to the advisor, and all you see is that your money's gone up or down. All right. And by the way, it may not have gone up as much as you would have expected it to because it got siphoned off for these fees. See, the problem in a great economy, as we're doing right now, like in a stock market that's gone up, is that you see your account value go up, but you don't realize how much more it could have gone up if there weren't the expenses associated with that particular investment. So what I want you to do before we take the break, all right, or at least write it down to do later, is I want you to go find your investment statement. And if you have that investment statement open, look at the mutual fund shares that you're in and take a look at the share classes. If you see a bunch of A's and C's in there, you know that you own investments that paid a commission to the person who sold them to you and is likely paying them an ongoing commission going forward. All right, and that might be in addition to whatever they're charging. All right. That segment went by really quickly. Stick with us. And when we come back from the next break, we're going to talk more about expense ratios and variable annuity fees. Geez, I hope we have enough time to get through it all. We'll get back right after this quick break.
Hey folks, you know there are more than 500 different ways to claim your Social Security benefits, and most Americans will rely on their IRAs and 401ks to survive retirement. The pressure to make the right decisions at this stage of life can be enormous, as are the consequences for making a wrong decision. Victor Medina, host of Make It Last, is a certified financial planner that specializes in helping people in or nearing retirement. Working with families that have been diligent savers and who value a trusted advisor, Victor is able to put together a customized total protection retirement plan that helps clients answer 4 important questions. Can you afford to retire? Are you overpaying your income taxes? Can your portfolio be improved? Can you eliminate or reduce threats to your retirement? It's never been more important to make sure your ducks are in a row, and it's never been harder to make your nest egg secure. The time to act is now. Call 609-476-9269 or email info@privateclientfamily.com to schedule your no-cost, no-obligation first meeting and get on the road to total protection.
All right. Welcome back, everybody. We are talking about your fees for investing. This is a great stock market that we're in right now. Things keep going up and up and up, but could you be just a little bit richer, a little bit more money, if your advisor had been recommending things that were a little less expensive for you. So we're talking a little bit about expense ratios. Now, to do that, I have to talk about mutual funds, because mutual funds tend to be one of the ways, or the most popular way, for people to diversify their investments. And so what they'll do is that rather than going out and trying to buy a bunch of stocks or a bunch of bonds and managing those individually, in which case they may not have enough money to own enough to diversify, they buy a mutual fund, and the mutual fund goes and takes and pools all this money, and they invest. And the mutual fund can have all kinds of planning philosophies. They can be just in equities, international, global, doesn't really matter what they do, but the idea is that they've pulled together money and helped you diversify by letting you own a bunch of stuff as part of one set of investments. All right. They have operating costs, and those operating costs are reflected in the value of the shares that you own. They might go up or down based on the amount of money that it takes to run those. And so the expense ratio is actually something that's published. You can go to Morningstar, and you can put in the ticker symbol for the mutual fund, and it will tell you what the expense ratio is. And what they do is they give you a percentage, and that percentage is a function of an annual fee that gets taken out in order for them to run their investments. Now, there was a study from Dalbar, and Dalbar is one of these objective agencies that goes ahead and does studies on investor behavior and things like that. And they concluded that the average mutual fund fee was 1.44%. All right. So we'll just use that number for our example, because this is the number that I use in my presentations and my seminars. When we do investing, the maximum average fee, the weighted fee, when we put somebody in the most expensive portfolio, the maximum of that fee is 0.33% annually. It's almost 1.1% savings on an annual basis. What's the effect of that? Now, I'm going to talk about some numbers, right? And I don't want you to get lost in the numbers, but when you invest money over time, because the fees are drawn out annually, it limits the amount of money you can make, because you're not compounding on the growth if there's persistent growth. So if I take a percentage off, like 1 full point off of that, and I take it out as operating expenses, then you don't have that money to then grow to the next amount, right? Because this is part of the concept of compounding. So what I did is I just illustrated, for purposes of education, what would the difference be if you had a portfolio made up of just a weighted average mutual fund, 1.44%, versus the most expensive fund family that we put together, and that's 0.33%. And the difference is staggering, because if you invested over the course of 10 years and just got the same average return, about 7% on average, if you invested $10,000 for 10 years and you had the more expensive portfolio, then you would have kept 73% of your money. If you had gone ahead and invested that with a 0.33%, then it would have helped you keep 93% of your money. So 93% of your money would have been kept. That's a 20% difference. You would have kept 20% more in that. Now, I think that is amazing. Amazing. Now, the reason why you might have been in the more expensive funds is because it pays the advisor extra money. So they were making those recommendations because the more expensive fund shares a portion of those operating expenses with them. Now, sometimes the more expensive fund is just doing things that aren't what we consider to be smart investing. They're doing more active trading. They're, following an index and just chasing money, and it costs more money to do that. But the idea here is that if you're following sort of this evidence-based investing, which is a little bit of what we do, you know that you want to keep the expenses low on that. And if you're acting as a fiduciary for your clients, as we do, then you know that it's not in their best interest to take commissions on ongoing expenses and then charge them a fee on top of that. It just doesn't work. So it's really important to keep those expense ratios low, because as we've seen when we run the numbers, in fact, it helps you keep more of your money. And within the context of a variable annuity, because kind of running out of time here, within a variable annuity, it's very similar to the expense ratio discussion, because one of the problems of a variable annuity is that there are fees that are embedded as part of the contract. So someone might be selling you a variable annuity. Oh, it's got this income rider, there's a tax deferral, and they got this whole conversation that they want to have with you about a variable annuity. But what they fail to talk to you about is that inside of the variable annuity, there are fairly significant fees. One of those fees can be what's called a mortality and expense charge. That's the cost essentially of insurance, because variable annuities are issued by insurance companies. So they will wrap that in an insurance wrapper, and that wrapper will cost, up to 1% annually. Then there's an administration charge or a contract fee, and that might get the number to 1.5%. Then on top of that, there might be a rider fee for you to have the, extra investments for the income benefit or something like that. That might be 1 or 2%. And then on top of that, there are fees for the investments inside the variable annuities. And so they say, okay, you gotta invest from this, let's say conservative, growth plus income, but those mutual funds themselves have operating expenses. And so when I've analyzed variable annuities, I probably just should give a whole show on this. We see that there's probably 3 to 4% annually coming out on fees. And that takes a significant bite out of the performance of these investment vehicles that, could otherwise be doing well. So the fees that I talked about today are fees that you can look up. There are hidden fees too, that are very difficult to talk about, trading costs, things like that, bid-ask price, some stuff that would kind of get your eyes to roll in the back of your head. But the expense ratio, the mortality and expense fees that are part of a variable annuity, your advisor fees, like if they're charging you something or not, those are all things that you can look up on your own and figure out how much you're paying. And there's some number that it's going to seem to make sense. But here's the point. You should know what you're paying for your investments. It should be crystal clear what you're paying, whether that's high, low, what the numbers are. And in fact, it should be in black and white. Like something that, like when we put a portfolio out, and we just closed in the quarter here, the statement that comes out talks about each one of the fees, our fees, the expense ratio fees, it's all listed in there, and we're super transparent about it. And you deserve to know more about the investments that you have, because you could be making more money when it comes to this if you were a little bit wiser about those investments. All right? So go do that. Either talk to somebody that's a fiduciary, call us or something like that, but or go look it up on your own, go to the Morningstar and figure it out, but go figure out what your investments cost. It is important enough for you to do that. Boy, we have run out of time. I'm going to spend a whole other show on variable annuities and just to talk about those, and it'll be a little bit of a recap, but these are important too because they get sold and oversold, and I just don't like them at all. And I hate ending on a down note, but we'll do it. We'll talk about variable annuities. Thanks for listening today. Thanks to the production crew for making us sound so good. If you like this show, please do me a favor and go on to iTunes and leave us a great review. It really helps the rankings on that. And share this show with friends. We know that there are people out there listening. Tell them about the iTunes link. Send them to the website and have them listen to this. This is a great one for them to get it introduced to because it helps them learn more about their investments, and share this information widely, because I think the more people know about it, the more people will be able to help control their future. I think that's important. Anyway, thanks for listening to Make It Last. We help keep your legal ducks in a row and your financial nest egg secure. I will catch you next Saturday. Thanks so much. Bye-bye.
The foregoing content reflects the opinions of Medina Law Group, LLC and Private Client Capital Group, LLC, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal strategy. There is no guarantee that the strategies, statements, opinions, or forecasts provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs.